Good day, viewers. I'm Binette van Wyk, Head of Distribution at Catalyst Fund Managers, and this morning I'm joined by Imdad Nana, an investment analyst and portfolio manager of our local long-only listed property capabilities.
Good day, everyone.
Imdad, it's been quite a tough start to 2023. I think it's due to a lot of local economic pressures, interest rates that have been raised consecutively, and then also there's a lot of continued structural challenges such as load shedding. Viewers, in today's session of our local listed property dashboard, we will be sharing a recap of the last 6 months of the local listed property sector with you. Imdad, I think let's start with the Eskom elephant in the room. Unfortunately, us as South Africans are far too familiar with the term load shedding. But there's this big misconception in the market that load shedding has a very negative impact on landlords' bottom line. Can you please clarify this misconception to our viewers today?
Sure. Load shedding is the most easily identifiable risk or impediment to growth. However, it is the most complex to solve. If you look at the listed property sector, a majority of the diesel cost and the maintenance thereof has been passed on to tenants. You're looking at a range of between 60 to 100%. Be that as it may, we estimate that from a sector perspective, you are looking at about a 1 to 2% impact on the bottom line because of load shedding in the short term.
Imdad, let's now turn to the three key subsectors of the local listed property market, that being industrial, retail, and office. Industrial has always been the darling of the sector, and then with retail, we've seen retail actually being quite resilient, despite the fact that we have a tough local consumer environment. And then we've got offices, which, as we sometimes call it, the foster child of the SA listed property sector. But if you look at the holistic market, offices is actually a very small percentage. It's only sitting at 14% of the OLP compared to a few years ago where it was a lot higher. But in the office space, fundamentals are very constrained. I think maybe you can just touch on like a few key takeaways of each of these sectors and share this with our viewers.
Sure. Maybe turning first to office, which is the toughest sector at this point in time. Vacancies are trending in the right direction. They are decreasing. However, they are still well above long-term averages. You are looking at about 15% national vacancy, which is still higher than the pre-pandemic peak, which was achieved in 2003. Because of the demand and supply imbalance, you are seeing rentals being under pressure because landlords are offering incentives and attractive rentals to either keep tenants or to acquire new tenants. If you're looking at industrial, on the industrial side, looking at 2022 data, they had the best base rental growth. But I think it's important from an industrial perspective to split it out between older manufacturing type industrial facilities and more modern logistics facilities. The older type assets or the older type industrial assets, they are still under pressure because of load shedding and the need for continued power supply for those manufacturing tenants. However, where we're seeing demand is in more modern logistics type assets. That's because of the growth in e-commerce, but then also the drive to improve supply chain efficiency from the national retailers. If you're looking at modern logistics, new build, the viability rentals, so the rentals that a developer would require to make a development profitable, has increased because of construction cost increases, but then also because of funding cost increases. So that is leading to market rental growth for existing facilities. Turning to retail, we have seen encouraging trading density growth from the companies that have recently reported. We do expect that to moderate because the consumer is under pressure. However, from a vacancy perspective, you are seeing low vacancies for good quality, well-located retail assets. And we believe that trend should still continue. On Central and Eastern Europe, the sector has a big exposure to this particular region and predominantly in the retail sector. We are seeing good trading density growth, low vacancies, and growing income streams. Their rental reversion, so that's when the lease expires, the new rental they are getting is positive and showing positive growth. So we're quite encouraged by that.
Sounds like fundamentals are improving slightly. Would that be a fair comment?
I think that would be a fair cautious statement at this point in time. But ultimately, the rising interest rate environment will have an impact on the economy and on the consumer.
MDOT, now touching on that point specifically about the rising interest rate environment, let's move on to balance sheets. The debt to asset level peaked during the COVID-19 pandemic at roughly 42%. And that was because property valuations were declining because of weak fundamentals. And then the theme of 2022 was exactly that. We saw monetary policy tightening, where central banks across the globe, including our South African Reserve Bank, or the SARB as we call them, were also hiking interest rates. If you had to summarize the current state of balance sheets of the SA listed property sector, what would be your key takeaways?
If you're looking at the structure of the balance sheets, typically you have about 75 to 80% hedged for about 2 to 3 years. What that means is that if there is an interest rate increase, not all of that is filtered into your income statement. It does happen through the passage of time as these derivatives expire and companies refinance facilities. So you are seeing rising interest rates affect the balance sheets more gradually from the listed property companies.
MDOT, and then last but not least, what is your outlook for the SA listed property sector?
Sure. The outlook is still uncertain. We still expect volatility in asset prices both locally and globally. Based on our model assumptions, which is very specific assumptions, we expect the sector to deliver a return of about 13 to 16% per annum over the next 5 years. It's important to remember that it might not all come in a straight line, but if you break down those components, you're looking at a FAD yield, so that's funds available for distribution yield of about 10%. The FAD yield is after we make a capex provision, because ultimately property you would need to spend continual capex to maintain its useful life. So we make a provision for that, and we believe that that is the sustainable level that the companies can distribute the earnings. Coupled with that, we're seeing about 3% growth in the short term. So if you look at your total return, or the total return I mentioned earlier, a bigger component is on the yield with a small element of growth. And then if we do have a bit more positive sentiment, we have better economic prospects, and we have a long-term solution to load shedding, you could also see a re-rate on the sector and the country as a whole.
MDOT, thank you so much for your time and for sharing your valuable insights with our viewers today.
It's a pleasure. Thank you very much.
Viewers, if you'd like to learn more about the SA listed property sector, please refer to our full H1 SA dashboard, or alternatively, reach out to me as per the details below. Thank you for your time, and goodbye.